Today on Open Exam Prep, we are covering a critical topic for the Securities Industry Essentials exam, anti-money laundering, or AML. Let's start with the foundation. The two landmark pieces of legislation you must know are the Bank Secrecy Act and the USA PATRIOT Act. The Bank Secrecy Act, or BSA, was the original law that established the basic requirements for financial institutions to help prevent financial crimes. Think of it as the groundwork. Then, after the events of September 11th, the USA PATRIOT Act was passed, dramatically strengthening those original provisions. For the exam, remember that the Patriot Act essentially gave the BSA more power, especially in the context of combating terrorist financing. So how do firms comply? It starts with two related but distinct concepts: the Customer Identification Program, or CIP, and the broader Know Your Customer Rule, or KYC. Think of CIP as the first date. It's the one-time process at the beginning of the relationship where the firm verifies a customer's identity. They'll collect the name, address, date of birth, and a government-issued ID number, like a social security number. The firm has to be reasonably sure that the customer is who they say they are. KYC, on the other hand, is the entire ongoing relationship. It's not just about who the customer is, but what they do. It involves understanding their financial profile, their investment objectives, and their typical transaction patterns. This ongoing diligence is what allows a firm to spot activity that deviates from the norm. When a deviation occurs, it might trigger a report. The two reports you must know are the Currency Transaction Report, or CTR, and the Suspicious Activity Report, or SAR. A CTR is straightforward and automatic. If a customer deposits or withdraws more than $10,000 in cash in a single business day, the firm must file a CTR with FinCEN, the Financial Crimes Enforcement Network. The exam loves to test this. For example, if a client deposits $9,000 in cash in the morning and another $2,000 in cash that afternoon, the $10,000 threshold has been crossed and a CTR is required. It's cumulative for that day. A common trap is forgetting this only applies to cash, not checks or wire transfers. Now, a SAR is different because it's based on judgment. A firm files a SAR when it suspects a transaction might involve illegal funds or has no lawful purpose, regardless of the amount. While a $5,000 transaction is often a guideline for filing, any suspicious activity can trigger a SAR. A classic example is structuring, also called smurfing. This is when a client intentionally makes multiple small cash deposits, like $9,500 each time, to stay just under the $10,000 CTR threshold. That pattern is highly suspicious and would require the firm to file a SAR. A critical detail for the exam is that you cannot inform the customer that a SAR has been filed about them. This is known as tipping off, and it's illegal. To keep these reports straight, remember this phrase: cash is tricky. Suspicion is arresting. Cash transactions over $10,000 are tricky, so they get a CTR. Suspicious activities are potentially arresting offenses, so they get an SAR. So, to recap, the Patriot Act beefed up the BSA. CIP is the initial identity check. KYC is the ongoing monitoring of the customer's financial behavior. And when it comes to reports, the CTR is for large cash transactions, while the SAR is for any activity that just doesn't seem right. Understanding these distinctions is key to mastering the AML questions on your SIE exam.